I wasn't looking for a documentary. I was reading an SEC filing, Apollo. One paragraph caught my attention. Investors had asked to redeem 11.2% of the fund. Apollo would honor only 5%. Then I reached the next sentence. Most investors would receive only about 45% of what they requested. I stopped, not because it sounded dramatic, because it sounded impossible. If I own an investment, how can I not get my money back? My first theory was simple. Something must have gone wrong. So I kept reading. But the filing didn't describe failing loans. It didn't describe a collapsing fund. Instead, Apollo reported roughly $724 million of new investor subscriptions during the same quarter. That completely broke my theory. Some investors were trying to leave, others were still buying. That doesn't happen when everyone thinks an investment is falling apart. So I went looking for the rule. Eventually, I found it, buried in the same filing. The redemption limits were consistent with the terms of the fund, which have been in place since inception. I read that sentence twice. The rule wasn't new. The investors had agreed to it from the beginning. Now the investigation had changed. This wasn't about a company refusing to return money. It was about an investment designed to return money differently than I expected. I needed to know if Apollo was unusual, so I opened the Federal Reserve's latest financial stability report. I expected to find nothing. Instead, I found something stranger. The report described increased redemption requests across some private credit funds. Then it said many of those funds had exercised their right to limit redemptions. Apollo wasn't alone. Now, two completely separate documents were describing the same thing. I still thought this might be a temporary problem. Then I opened an older Federal Reserve report. A chart immediately stood out. Private credit assets hadn't been shrinking, they had exploded. From a relatively small market to around $1 trillion. I wasn't looking at a niche investment anymore. I was looking at one of the fastest growing parts of modern finance. That raised another question. Who was putting all this money into these funds? The next chart answered it. Pension funds, insurance companies, individual investors. This wasn't just billionaire money. Millions of ordinary people's savings were connected to this market through institutions. Now I knew I was asking the wrong question. The real question wasn't, why couldn't investors leave? It was, why would so many sophisticated investors willingly accept that risk? To answer that, I opened one more document, this time from the IMF. And almost immediately I saw the same word that had already appeared in every investigation, liquidity. At first, I thought liquidity simply meant cash. The more I read, the more I realized it meant something else. It meant time. How long does it take to turn an investment back into money? For a public stock, maybe seconds. For a private loan, it could take months. That changed everything. Apollo wasn't promising investors instant access to loans that couldn't instantly be sold. The redemption limits suddenly made sense, not because they were convenient, because the assets themselves weren't liquid. But one question still bothered me. If everyone in the industry already knew this, why were regulators talking about it now? The IMF answered that. It estimated that roughly $300 million of private credit assets were now held inside semi-liquid funds, funds that offered scheduled withdrawals while investing in assets that couldn't always be sold quickly. That's where the tension appeared. The IMF wasn't warning that the loans had disappeared. It was asking what happens when withdrawal requests arrive faster than those loans can realistically become cash. Then I went back to Apollo's filing. The company described its quarterly liquidity as considered and intentional. That sentence suddenly sounded very different. The restrictions weren't protecting Apollo, they were protecting the structure of the fund. Without limits, the manager might be forced to sell loans at the wrong time, hurting investors who stayed behind. That was the counter-argument I hadn't expected. Then another Federal Reserve chart completed the picture. Private credit wasn't owned only by wealthy investors. Large pension funds, insurance companies, universities, retirement savings, they all had exposure to this market. These institutions weren't ignoring liquidity, they were accepting it, because in return, they expected higher yields than many public credit investments could offer. That's the trade: higher return, lower liquidity. Neither side is free. And suddenly, I realized something. I had started this investigation believing Apollo's filing exposed a broken investment. It didn't. It exposed a broken assumption. For years, public markets quietly taught us that every investment has an exit. Private markets never made that promise. We simply forgot to ask the question. Not, what could I earn, but when can I actually get my money back? After reading Apollo's SEC filing, Federal Reserve reports, IMF analysis, and the documents written for investors themselves, I reached a very different conclusion than the one I expected. The biggest risk isn't always losing money. Sometimes, the biggest risk is discovering the exit isn't there when you need it most. Because sometimes, your money isn't missing. It's trapped.